This week, the big theme was the labor market, and it was finally starting to show cracks, and that really matters a lot for interest rates. We saw several labor reports come out that were weaker than expected and matches what I've said in past, these weekly updates about the job market being weaker than the numbers show. We got Challenger job cuts, and it showed a sharp jump in layoffs. It was actually the highest increase for a January since the Great Recession. And jobless claims also came in higher than expected, although some of that might have been related to the winter storms. And the delayed JOLTS report we got also showed fewer job openings, which again tells us companies just aren't looking to hire the way they used to. And to put it simply, demand for workers is cooling. Companies aren't aggressively firing, but they aren't hiring either. And many people who lose their jobs are turning to gig work instead of showing up in the unemployment numbers, and that makes the job market look healthier, at least on the surface, than it actually is. And here's why this matters for rates. When we see a softer labor market, that gives the Federal Reserve more room to cut rates later this year without worrying about inflation flaring back up. And that idea was reinforced this week by the incoming Fed chair, Kevin Warsh. He said he wants to cut rates and believes that the advances we've seen in AI that have led to more productivity does give the Fed more flexibility to do that without creating inflation, like I said. And that's really important because it signals a more forward-looking approach than what we've seen by the current Fed. And on the housing side, we got a reminder of why homeownership still matters long-term. Roughly 2/3 of household wealth in the U.S. is tied to home equity, and home values have actually risen in almost every year over the past 8 decades. And homeowners today have dramatically higher net worth than renters. So even if you look over the last 5 years, the typical homeowner's net worth increased significantly despite recent price pullbacks in a few markets. If you have Bitcoin, on the other hand, it was a rough week. We saw crypto prices pull back a ton with money moving into precious metals. And while crypto adoption does continue to grow, this move does show you that investors are becoming a little more cautious and kind of shift toward assets that are seen as more stable when times are uncertain. It is a speculative and highly volatile investment. But looking ahead, next week is a big one. We're going to get retail sales, mortgage applications, that delayed government jobs report, and some inflation figures. And the jobs report on Wednesday will be especially important as markets are watching closely to see if it confirms that labor market weakness that I mentioned we've been seeing elsewhere. We are moving in the right direction, but the next few weeks will matter. That's it for this week. I'll see you next Friday.